Gold just ripped through the psychological ceiling again, above $4,000 an ounce in 2025. And now one of the biggest names on Wall Street is putting a stake in the ground. JP Morgan says gold could average around $5,055 an ounce by Q4 of 2026. Let that number sit for a second. Because if gold is heading there, this isn't just a nice rally. This is a full-blown repricing of what safety costs in a world that doesn't feel stable anymore. Here's the thing. People hear a forecast like 555 and they assume it's hype or a headline grab. But the real story isn't the number, it's the plumbing behind the demand. Who's buying, why they're buying, and why the supply side can't just magically catch up. Now zoom out with me. We've seen this movie before, just with different costumes. In 2008, the system cracked, trust evaporated, and gold started acting like an insurance policy against institutional failure. In 2011, fear of sovereign debt and monetary experiments pushed capital into hard assets. In 2020, stimulus and zero rates made cash feel like a melting ice cube, and gold responded. But 2025 into 2026 is a different kind of setup. This isn't only a crisis bid. It's not just panic buying. It's something slower, more structural, and more important. It's the world quietly rebalancing away from dependence on the dollar system, while investors, at the same time, are relearning what it means to own an asset with no counterparty risk. That's why the gold move feels so stubborn, so persistent. Even when the pullbacks hit, it keeps coming back. And JP Morgan's argument is basically this: the drivers aren't exhausted. Even if the path is choppy, the force underneath it is still pushing. Now let's get into the proof, the actual data, because this is where the narrative turns into something you can measure. JP Morgan points to a surge in combined demand from investors and central banks. In the third quarter of 2025 alone, total investor demand plus central bank demand came in around 980 tons. Think about that. Almost 1,000 tons in a single quarter. And that figure, they describe it as more than 50% higher than the average pace of the previous 4 quarters. Now the tonnage is important, but the dollar value is what should make you blink. At average prices around 3,058 an ounce in that quarter, roughly 950 tons translated to about $109 billion of quarterly demand inflow. One quarter, 109 billion. And they frame that as roughly 90% higher than the average of the prior 4 quarters. So when people ask, why is gold doing this? Part of the answer is painfully simple, because enormous pools of money are choosing gold over and over at record prices. And they're not doing it because it's trendy. They're doing it because it solves a problem. Now, JP Morgan's forecast framework is also very specific, and it matters because it tells you what they think moves price. They're leaning on a relationship between quarterly net demand, measured in tons, and changes in gold prices. In their work, that relationship explains about 70% of the quarter-to-quarter moves. That's a big claim. And whether you agree with the exact percentage or not, the takeaway is clear. Flows matter a lot. They put a kind of threshold on it. Around 350 tons per quarter of net demand from investors and central banks is what S needed for gold prices to keep rising each quarter. And here's the kicker. Every additional 100 tons above that level is worth about a 2% quarter-over-quarter rise in the gold price. So now you can see why they care so much about the 2026 demand assumptions, because their 2026 baseline is still heavy. They're modeling around 585 tons per quarter on average, coming from investors and central banks combined. Not 350, not barely supportive, 585. That's the kind of flow regime that doesn't just support prices, it pushes them, it grinds them higher, it makes dips feel like speed bumps instead of cliffs. And the demand isn't coming from one single bucket, it's layered. They're looking at central banks averaging about 190 tons per quarter. They see bar and coin demand around 330 tons per quarter. And then they expect ETF and futures demand around 275 tons annually, with a lot of that activity front-loaded. Now let's talk about the elephant in the room. Central banks. Because if you want to understand why this move feels different than the old gold cycles, you have to understand the official sector. Central banks have been buying over 1,000 tons a year for 3 consecutive years. That's not a fluke, that's policy. And JP Morgan's view is that even if 2026 central bank purchases cool from the recent peak, they're still elevated. They're projecting around 755 tons in 2026. That's below the 1,000 plus years, but still well above the older pre-2022 norm of roughly 400 to 500 tons. And the reasoning they give for the slowdown is important. because they don't want gold anymore. It's mechanical. When gold is 4,000 and higher, the central bank doesn't need to buy as many tons to increase gold's share of reserves. The percentage target gets met with fewer physical ounces. Same goal, fewer tons. Because price did the heavy lifting, and official reserves are already shifting. Global central bank gold holdings are nearly 36,200 tons, and around 20% of official reserves as of end 2024, up from about 15% just a year earlier. That's not a minor change. That's a reallocation. And then they run a scenario that should make you sit up straight. They say, if central banks that currently have less than 10% of reserves in gold simply moved up to 10% at 4,000 an ounce, that implies about $335 billion of notional shift into gold. That's around 2,600 tons. Even at 5,000 an ounce, the same exercise is still $194 billion, around 200 tons. So the key message is, even with gold already expensive, the catch-up trade is still enormous. Now add the second pillar, investors. JP Morgan talks about investor positioning remaining net long in futures, but they also emphasize that futures are just one slice. The broader investor ecosystem includes ETFs, physical bars, and coins. And their 2026 expectations aren't timid. They're reforecasting around 250 tons of ETF inflows in 2026, and they expect bar and coin demand to exceed 1,200 tons for the year. And here's a detail most people miss. Gold is still not over-owned by the big money relative to history. They cite investor holdings of gold, including ETFs, bars and coins, and COMEX futures, at about 2.8% of total assets under management across equities, fixed income, and alternatives. 2.8%. They argue there mess room for that share to move toward 4 to 5% over the coming years. Listen, a move from 2.8% to even 4% doesn't sound dramatic. But on global AUM, that's massive. That's the kind of slow allocation shift that can power a multi-year trend. Now we get to the part that makes this forecast feel almost underappreciated. The new demand. JP Morgan flags two pools that could expand gold's ownership base: Chinese insurance companies and the crypto industry. And this is where the narrative gets spicy, because it tells you gold isn't just competing with bonds anymore. It's competing with new definitions of store of value. Think about the psychology here. Chinese insurers are long-duration institutions. They think in decades. If they become steady buyers, that's not hot money, that's structural money. And the crypto community, that's even more interesting. For years, a huge chunk of that culture positioned Bitcoin as digital gold, sometimes in a collaborative way, sometimes as a replacement. But markets don't care about ideology, they care about portfolio construction. If parts of the crypto ecosystem begin to treat physical gold and gold-backed instruments as complementary collateral, or as a volatility dampener, you suddenly have a new buyer class that didn't exist in prior gold bull markets. That's not just demand, that's narrative reinforcement. Gold becomes the base layer hedge again, not just against inflation, but against political risk, currency fragmentation, and financial repression. Now let's get into the deeper mechanics, the why beneath the numbers. Gold has been acting as two things at once. One, a debasement hedge, a bet that fiat systems will keep leaning on debt, liquidity, and stealth devaluation over time. Two, a competitor to yield, a non-yielding asset that still attracts capital when confidence in real yields, or confidence in fiscal discipline, starts to wobble. And in this cycle, even when nominal rates are high, the market keeps running into moments where certainty disappears. Tariff uncertainty, trade friction, geopolitical risk, questions about the reliability of alliances, supply chains, payment rails. That uncertainty makes gold feel less like a commodity and more like a neutral reserve asset. And here's the part retail investors often underestimate. Supply doesn't respond quickly. Gold mining supply is relatively inelastic. You don't just flip a switch and produce hundreds of tons because price went up. New projects take years. Permitting takes years. CapEx cycles take years. Political risk at mine sites is real. So if demand surprises to the upside, price does the balancing, not production. JP Morgan even lays out a scenario that basically says, if diversification accelerates, 5,000 might not be the end of the story. They describe a case where if just 0.5% of foreign holdings of U.S. assets diversified into gold, now you don't have to take the exact 6,000 literally, but you should understand the implication. Tiny percentage shifts in gigantic portfolios can create enormous pressure in a market that is physically constrained. That's why gold can move in these violent repricing waves. It's not that everyone in the world is buying a lot, it's that a few very large pools decide to buy a little consistently. Now, what does all of this mean for you, the person watching this, trying to decide if this is a trap or an opportunity? Here's the mentor part, and I want you to listen closely. First, don't confuse a bullish long-term setup with a straight line up. Even JP Morgan is careful about that. They're basically saying this won't be linear. Translation, there will be pullbacks that feel scary. There will be weeks where gold drops hard and the headlines scream top. There will be rotations into risk-on assets when markets calm down. That's normal. Second, in a structural bull market, smart money doesn't chase candles. They build positions on weakness, and they size the position so they can survive volatility. If your gold exposure is sized so big that a 7% drawdown ruins your sleep, you don't have an investment, you have stress. Third, think in layers, not in one bet. For some people, that's physical gold as core insurance, and liquid exposure through a trusted vehicle for flexibility. For others, it's a mix of gold, short-duration cash instruments, and selective risk assets. But the key is, gold is not there to make you rich overnight. It's there to keep you solvent and steady when the rest of the system gets weird. Fourth, watch the drivers that actually matter in this framework. If central bank buying stays elevated, if ETF flows remain positive, if bar and coin demand stays firm, and if new buyers like large Chinese institutions or crypto-linked capital start building exposure, then dips are more likely to be opportunities than warnings. And if you want one simple litmus test, ask yourself this. When gold sells off, does it bounce on real buying, or does it drift because nobody shows up? In strong bull phases, buyers show up, quietly, relentlessly. Now let's land this. JP Morgan is essentially saying the gold bull market isn't just alive, it's being fed by central banks, by investors, and potentially by entirely new pools of demand that could expand the ownership base. Their line in the sand is 5,055 by Q4 2026, with a view that prices could keep pushing beyond that afterward. Two takeaways. One, this move is flow-driven and structural, not just emotional. Two, the biggest risk isn't volatility, it's being unprepared for a world where safety costs a lot more than it used to. So here's my question for you, and I want a real answer in the comments. Do you think the next wave of gold demand comes more from central banks or from private investors and institutions trying to diversify away from dollar exposure? And if you want to stay ahead of these shifts before they hit the headlines, subscribe. Because this next phase isn't about hype, it's about positioning.